Can you really retire a millionaire with just 3 simple investments? No stock picking, no staring at screens all day, just pure, long-term growth. The answer is yes. First, let's break it down. An ETF, or exchange-traded fund, is like a basket. Instead of buying one apple, you're buying a slice of the entire orchard. It trades instantly like a stock, but gives you the safety of diversification. Most people lose money trying to beat the market. They panic sell, they chase trends, they overcomplicate it. But the data shows that simple, passive investing outperforms professionals over the long run. Why pick a needle in a haystack when you can just buy the whole haystack? Diversification means if one company fails, your portfolio stands strong. It's the only free lunch in investing. And the secret sauce? Compound interest. It's not about timing the market, it's about timing the market. In this series, we're going to build the perfect 3-fund portfolio to harness this power. Next, we'll reveal ETF number 1. Welcome back. In part 1, we built the foundation. Now, it's time to install the engine of your millionaire portfolio. This single ETF will be the heavy lifter, responsible for the majority of your long-term growth. Meet the total stock market index. When you buy this ETF, you aren't just buying Apple or Amazon. You're buying them, plus 3,500 other companies across the United States. You own the banks, the factories, the tech startups, and the healthcare giants. You literally own the American economy. The beauty of this index is that it's self-cleansing. Failing companies naturally drop out of the index, and innovative new companies rise to take their place. You don't have to pick the winners. The market does it for you automatically. Over the last century, despite wars, recessions, and bubbles, the US market has returned an average of about 10% per year. That is the power you are harnessing. It's betting on human innovation. But wait, the US is only one country. What happens if the dollar crashes? What about the rest of the world? In part 3, we're going global to bulletproof your wealth. Don't miss it. So you own the entire US economy. That's great. But here is the hard truth. The United States makes up only about 60% of the global stock market. If you only buy American, you are betting everything on one country. That is a risk. Enter ETF number 2, the Total International Stock Market Index. This fund buys thousands of companies in Europe, Asia, and emerging markets. We're talking giants like Samsung, Toyota, Nestle, and TSMC. History shows that winners rotate. In the 2000s, US stocks did nothing for 10 years, while international stocks soared. In the 2010s, the US took the lead. By owning both, you win no matter who is on top. By adding this ETF, you now own the entire world. Capital cannot hide from you. If a new tech giant emerges in India or Germany, you profit. You are fully diversified. But stocks are volatile. They crash. How do you sleep at night when the whole world is bleeding red? In part 4, we add the final piece, the safety net. Stocks build wealth, but they are a wild roller coaster. In 2008, the market dropped 50%. Imagine seeing half your life savings vanish overnight. Could you handle that? Most people can't. That's why you need ETF number 3, the Total Bond Market Index. While stocks are ownership, bonds are loans. You are lending money to the government and high-quality companies, and they pay you interest. Think of bonds as the shock absorbers of your portfolio. When stocks hit a pothole and crash, bonds often hold steady or even go up. They smooth out the ride so you don't panic and sell at the bottom. Plus, they pay you. This ETF distributes monthly interest payments. It's a steady stream of income that keeps flowing, rain or shine. It's boring, and boring is good for your sleep. Now you have all 3 components: the engine, the hedge, and the safety net. But how much of each should you buy? In the final part, we put it all together and give you the exact percentages. You have the engine, US stocks, the hedge, international, and the safety net, bonds. But how do you mix them? The answer depends on your age and risk tolerance. But here is a classic set and forget allocation. Consider the 60/20/20 split. 60% total US market for growth, 20% international for diversification, and 20% bonds for stability. This portfolio has historically survived every crash and delivered solid returns. Once a year, you rebalance. If stocks go up and bonds go down, you sell some stocks to buy cheap bonds. You are forcing yourself to sell high and buy low without letting emotions get in the way. Does it work? If you invest just $500 a month into this portfolio, with an average 8% return, in 40 years you won't just be a millionaire. You'll have over $1.6 million. The math is inevitable. Investing isn't about being smarter than everyone else. It's about being more disciplined than everyone else. Time is your greatest asset, and it's ticking. Start your 3-fund portfolio today. Thanks for watching.